Jack Martin joins me here today. You can learn what his team is up to. Head over to 5210.com, and it's 52 and then spell out TEN.com. I'm going to have that as a clickable link in the show notes, but we're going to be talking about all things mobile home parks.
Hey, one other thing, my general perspective is to add value to your listeners. So this is education and try to give some value to your audience. That's the general initiative here.
Okay. No, I appreciate that. We have Jack Martin joining me here today. You can learn what his team is up to. Head over to 5210.com, and that's the number 5, the number 2, and then spell out 10, TEN.com. It's going to be a clickable link in the show notes. We're going to be talking all things mobile home parks today. I really appreciate your time today, Jack.
Well, I appreciate the invitation, Jack. So it's pretty neat to be on a podcast.
Well, I'm telling you, there's kind of a trend among us real estate investors. There seems to be a lot of us lacking follicles and growing the gray beards.
Yeah, well, I carefully curate this look every morning. It takes me all of 2 seconds. The Lord gives a nice shaped head to those who he takes the hair from.
Yeah, I'd like to believe that, but I'd be curious. Let's start things off with your origination story. You know, we typically see that in superhero movies, but we need to hear your story. How did you find your way into real estate investing, particularly finding that niche in mobile home parks?
Yeah, the mobile home park story is kind of neat. It's a little serendipitous, and it was a bit of at the time, we tripped over mobile home parks. My interest in real estate goes back to my days in the U.S. military. So this was back when late night TV had Carlton Sheets selling the cassette tape series for $19.99 or whatever it was.
Mm-hmm.
I was enamored with the program. I bought it and I listened to that program every time I had an opportunity while I was in the military. When I got out, I got into general contracting, got my general contractor's license, and then I got into real estate investment through development. So we were purchasing land, building spec homes, selling homes, and doing that sort of thing. And then if you recall when Robert Kiyosaki came out with his cash flow game, there was a group of buddies that were playing that game for fun. And the idea surfaced that why don't we play this game for real? So we began buying up little rental homes all throughout Phoenix. And then that led to scaling where we were at one point one of the largest wholesalers in Arizona. So we did about 200, 250 homes a year. And they were all single family done one by one. Got a little bit bored with that and I pivoted to apartments. Initially, it was the 4plexes and the 10plexes and that kind of thing, but that quickly scaled to private equity, building syndications and doing apartments in the 50 to 150 unit size. And then I tripped over mobile home parks. So I was actually doing a apartment in a small town in Arizona, as a mountain town called Flagstaff. It was a building that had been vacant for several years. It was perfectly suited to be an apartment. So I approached the city. The city said there's not enough parking. So I went next door and bought the mobile home park that was next door, just a little one. Long story short, the city didn't ever give us the approval to bring that building back online, but now I own this mobile home park. So I dug my hands in and I learned all about mobile home parks and fell in love with it. And then kind of the origin story of 5210 is we look back at 2008 and how even if you were a great operator and you were relatively conservative with your debt, when the market went down, it even brought good operators down. The volatility that exists inside of apartments, for example, causes vacancy to occur. And if you have debt that can no longer be serviced, you can't refinance because your DCR score is too low. And then the bank will take back your asset, even if you were a good steward of the asset. But where we didn't see that happening was with mobile home parks. I didn't see a single foreclosure in all the research that I did. When I spoke with mobile home park operators that have been in the business for generations, their view was that not only are mobile home parks stable, they really shine when the economy's bad. So we started 5210 specifically to focus on the asset class where the rug couldn't be ripped out from underneath us. Preservation of capital is a big deal. So that's the origin story.
Well, you've kind of alluded to this fact, but this is a particularly stable asset class, especially independent of the economy. Can you talk a little bit about your experience there? Like, what happens with these parks? We're in a shortage when it comes to housing as it is. So low income housing and a nice environment is probably hard to come by.
Yeah, there's really two things to spotlight here, and I'll speak to our experience with COVID because I think that that shines a light on how did mobile home parks perform when there was strategic default by residents or by tenants. The success of mobile home parks starts with the affordability. So on average, the cost to live in a mobile home park is about half of the next best option, which is an apartment. So same neighborhood, comparing apples and apples with respect to quality or standard of living. So good quality, clean property, not a trailer park. We're not talking about trailer parks. We're talking about manufactured housing communities where, you would be comfortable having your daughter live there or your mother live there. But the attraction is the affordability, and that's a constant perpetual demand. When things are expensive, people are seeking something less expensive. And when the economy is correcting, people are typically moving out of something that has become unaffordable. So they're moving from the apartment down to something that's more affordable. So it's more budget focused, but these can be really clean. I mean, a lot of mobile home park tenants prefer it over an apartment because they don't have a resident above them or below them. They don't have to go up and down stairs. They don't have anybody beside them. They actually have a little yard that they can call their own. They have their own parking spot right by their front door. So they're not wandering through a community in the dark. So there's a lot of things to like about mobile home parks, but certainly demand is the thing that as a owner and investor in mobile home parks, that's the thing that I like the most. There's always demand for affordable housing. But what few people know is that the penalty for non-payment of rent is the forfeiture of your home. So this is the only asset class in real estate where I own the land, but I don't own the homes. So the residents come, they choose a home, they buy it, and they pay me basically the rent for the parking space that their home sits on, and then they pay their own utilities. I take care of the streets and the landscaping and the clubhouse and the lighting and security and all those kind of things. But if they fail to make the lot rent payment when they get evicted, the penalty is the forfeiture of their home. Mobile home, that's nationwide. That's not something that's just in a single state. But because mobile home park residents know that, strategic default is off the table. So if we go back to COVID, I knew a lot of really good quality operators that owned buddies of mine that owned apartments, and their rent collections were down 40 to 50% just because of strategic default. The tenant knew that can't evict me because there's a moratorium. And when the moratorium is lifted, I'll just move out and go to somewhere else. But in the meantime, I live here for rent free. So in a mobile home park, if someone were to do that at the end, when the moratorium is lifted, they would have to catch up on all of the back rent and late fees and penalties, or they would be evicted and they would lose their home. So it doesn't make any sense for them to do that. Our experience is we collected 100% of our rent during that volatile time when COVID was here.
Hey, that's interesting because when you say that, I'm having flashbacks because I was one of those people that had rental properties, and you could actually tell when they got the stimulus money because I had to deal with boxes of brand new televisions that they had purchased instead of paying the rent.
Yep.
So you mentioned Clubhouse in your environment here. Are you are you trying to create actual, like, I would call them more community based environments? And the reason I'm asking that, most people are going to hear, we hear talk about mobile home parks or trailer parks.
The stereotype is changing. What's interesting is I grew up driving by mobile home parks of all different sizes and flavors my whole life. And the stereotype is that's trailer trash. That's just, where you go if you want to get, you name it, any illicit thing, you could probably get there. That stereotype is starting to change. So we're seeing a lot of youth, especially the 20 to 30-year-old crowd, who are seeking affordability. They're starting a family and that stigma is not present. But I think another thing that's changing is that the quality of these mobile home parks, especially the older kind of tired mom and pop mobile home parks, their opportunity is to take those and bring those back to life. So there's a star rating in the mobile home park asset class that goes from 1 to 5. And it's similar to what you would see in commercial real estate, going from Class A, Class B, Class C, and so forth. A 1-star park is where you wouldn't want to go at night. You certainly wouldn't be comfortable with any of your family members living there. A 5-star park is a brand new gated luxury community. It's basically a manufactured housing subdivision. They're usually gated with all the amenities, clubhouse and pools and spas and sport courts and all of that fun stuff. The opportunity that we see in this space is kind of in the middle. So, an older property that has been either mismanaged or kind of neglected, or maybe there's just no professional management and, there's no motivation by the existing owner to do any improvements to it. The streets go bad, the landscaping goes bad, even the condition of the home starts to suffer. Everything starts to look neglected. The opportunities that we pursue are both neglected physically and neglected operationally. And those two things typically lead to a deal that makes a lot of sense financially. But we stay away from trailer trash or tough neighborhoods. We want to own clean, safe communities that are essentially subdivision filled with mobile homes.
Is it true that a lot of communities, frankly, just don't want them in their backyard anymore? So really the only option is to track them down from these mom and pops or existing owner operators.
There's a little bit more to it than that, but yes, the NIMBY thing is still present. And I think it's because of the potential for blight. So if you think about a mobile home community can attract, improperly run and improperly managed, the potential for blight is present. Probably wouldn't see that in a brand new community today because that's a 5-star gated community. The only way to make it make sense is to put really nice homes, attract people that are willing to pay a premium to live in a really nice brand new community. The likelihood of that happening is extremely low, but that doesn't mean that the people in the neighborhood are still afraid of it. So that NIMBY dynamic is present. But the biggest challenge you have for the development of new parks is that the cities don't really want them. Even though on one side of their mouth, they'll say, hey, we have initiatives to provide affordable housing solutions. On the other side of their mouth, they recognize that the tax income that comes from that property is substantially lower than it could be if you just built apartments there or condos or something like that.
Mhm.
So I think the other challenge is mobile home parks are not vertically developed. It's a single story home and they're typically low density. So whereas an apartment complex can be several stories high density, they share walls, they share the same parking lot. So you might be able to get, 5 to 10 times more units on the same piece of dirt that you could a mobile home park. So not only is the lot rent collections lower in a mobile home park than it is in an apartment, you also have substantially less units available. And all of that ends up with less tax revenue for the city. Then you start to look at the city's requirement or a desire to provide services to everybody who lives there. And then that starts to kind of become difficult because the little bit of tax revenue that they're collecting, they still have to provide schools and school buses and, all of the city services to that low density product. So then you say, okay, well then why wouldn't they be built out in the country? Utilities, that becomes the problem. So just about every way that you try to analyze why can't we build more affordable housing, you just end up getting stuck or roadblocks everywhere. Now, do they get built? Yeah, there's still probably 10 new mobile home parks on average that get built across the United States. That's not very many, especially at the pace that these are being knocked over for redevelopment. So some of these older, tired properties are sitting on premium land within a city center, and they're getting purchased for the land. and they knock them over and they redevelop them into something that's vertical. So it's a shrinking asset class. They're going away faster than they're being built.
Just to remind everybody, we're talking to Jack Martin from 52ten.com. You could learn more by heading over to their website. If you found some value in what we're talking about so far, do us a quick favor, share this with one of your investor friends. If you're watching us on YouTube, give us a quick like and subscribe. So, Jack, could you talk a little bit about what do you do when you take over an existing facility? I'm sure you run into frequent low-hanging fruit as to some things you can maybe change to get the most bang for the buck, if you will.
From a kind of simple high level view, the two things that we're seeking to do is to increase revenue and lower expenses. That's pretty generic. Where we see opportunity to increase revenue is going to be utility reimbursement. So that'll kind of impact both sides. Most of these mobile home parks are built with a single master meter for water coming into the park. And then there's a flat fee that gets charged to the resident, or it's just a function of their rental fee. But what ends up happening is twofold. Tenants don't have the responsibility requirement to meter the amount of water usage if they're not paying for it. And the second thing is, if there's a leak in the park, you can't tell. You don't know if there's an underground leak unless you see it bubbling up somewhere. So by sub-metering each home, you can charge back the actual usage for water. So the person who wants to water their flowers every day has to pay more water fees. And usually those will translate into sewer fees too. The more water you run through your sewer pipe, the more sewer fee you end up paying. So it allows you to collect for the actual expense rather than just guessing and trying to get a flat fee. Most older owners or vintage owners are not really interested in spending the money or the time to put that into effect. There's some really cool water meters out there where they're all Bluetooth capable. They populate the monthly usage directly to the software, and it just ends up right on the bill, and it just goes out with the rental bill. So it's not as difficult to execute the use of today as it was maybe a decade ago, but it still costs money to do that. In addition to that, if the total water usage coming through the master meter and the total of all the water usage on all of the sub meters is not the same, you have a leak. So it's an automatic leak detection system. And then you get somebody out there to discover where the leak is and you can plug that. So there's opportunities to use space that hasn't been used so we can develop extra sites. Sometimes there's an old building or, activity center or something that's just never been utilized and we can bring that back to life. There's cases where we'll actually rent out executive office suites and gain some more income there. Sometimes there's billboard opportunity or cell tower opportunity. Depending on the extra land, sometimes we can put ancillary storage income. There's a host of things that you can do, but the kind of bread and butter is make sure that you have all of your expenses tightened up. You're not overpaying for vendor services. There's a dozen things on the expense side that they might seem small individually, but when you execute on all of them, it becomes a big deal. And then on the income side, besides all of these creative ideas, typically we'll go put money into the property and make it the nicest. Our goal is to have the nicest community of its quality in the neighborhood, and then you can align the rental rates with market. So a lot of times previous owner hadn't been putting money back into the property. They also justify that by keeping the rents low.
Mm-hmm. So, I was going to ask you, you're acquiring these properties, and I'm sure you are experienced in dealing with various forms of blight. I would have to imagine you are going to run into some people you just frankly don't want their houses there anymore. Like, how do you handle that type of thing?
That's probably a little rare for us, a little more common if you step down into the 1 or 2 star space. We typically won't buy something unless it's 3-star or above. But in the rare case that occurs, and we've gone to the extent where we approach them because they won't fix up their home. It's not ours, it's theirs. Maybe it's the only home in the community that needs attention, and we'll offer to do it for them. On the exterior, if they don't want to remodel their interior, that's fine. But you can completely remodel the exterior of a home with skirting, new siding, and a roof for about $15,000. Well, if you have a 150 space property and you spread that cost out over the whole property, you've improved the community with $15,000, and the entire community is going to appreciate that. So that's probably a bit of an extreme example, but we have done that on a really nice park where when we purchased it, there were just a handful of old homes. When you make dramatic improvements to a property and you bring brand new homes in and you sell those to residents who are willing to pay a premium to live in a really nice community, and you add all these amenities, and this particular one, we gated it with state-of-the-art electronic gates and all this really nice stuff. And we assumed that this person would just move out, because along the way, as you improve the community, then you start to align rental rates with market. But they love the community so much, they continued to pay the increased rent. So then we said, okay, well, I guess we'll just offer to fix it for them. But typically we don't run into that. I think you'll see that a little bit more if you buy a property where it's a little bit lower quality asset. Maybe there are no amenities, and it wouldn't make sense to develop out amenities, but we don't run into that because we don't buy those parks.
I suppose that they probably saw increased value. Like as you were improving things, if they see the value in it, the money is likely going to be there. So they'll just keep paying the rent.
Yeah, well, I think that's the point. Like, the responsibility for park owners in this affordable housing space is, even though there might be an opportunity, if you look at rent comps, that we could just raise the rent up to the comparables, that you should still improve the experience of the resident who lives there. So, be a good steward of your residents. And that fosters a partnership between the owner and the residents where they're all excited and we're on the same page. You guys want an incredible living experience here. We're going to give that to you. And then in return, you're going to pay a premium for the increased experience.
Yeah, I'd be interested in how you underwrite this asset class. Like, can you kind of give us a little insight as to how you find them, how you underwrite them, how it might be different from a multifamily investment, that type of thing?
Having been in the multifamily space, it is similar. So you're still managing or operating, 100 plus residents on the same property. So in effect, it behaves similarly. The thing that stands out in the difference between multifamily and mobile home parks is typically you have park-owned homes, or a combination of the following. You have tenant-owned homes, which is what you want. You want a tenant to own the home on every space. But most cases, when you acquire a park like this, you'll have tenant-owned homes. You'll have some park-owned homes, and those are either rentals or they're vacant. Maybe they're homes that we're trying to sell and we couldn't sell, or homes that used to be a rental and they're vacant. Then you'll have vacant spaces that need a home. And then sometimes you'll have an RV on one of those vacant spaces. So there's kind of a wide variety of dynamics that can be present when you purchase a park that needs to be brought back to life. Our goal is to model out the speed at which we can convert that to 100% tenant-owned homes. And you have to get the speed right. So it's important to be conservative, because whereas in an apartment, if you bought an apartment where you have a combination of occupied units, a combination of vacant units that are both ready to lease and needing improvements before you can lease, you could take that condition in a market with good demand for apartment residents, and you probably could complete it in 12 months if you're, relatively good at what you do. That's not the case in mobile home parks. So you're actually selling homes. You have to order them from the factory, and the factory delivers them. And then there has to be contractors who come in and set them up and skirt them and put the concrete and the awnings and air conditioning and landscaping and finish them out. Then you put it for sale, and then you have to attract a buyer, not a tenant. This is a permanent owner of the home who has to go off and get financing typically. So it's the whole lending process. And then they move in, they get the keys, they start paying your lot rent, and they're paying the lender a payment on their home. But the huge difference is that they're making a permanent housing decision. So it's ownership. Whereas in most rental product, there's no ownership at all. There's no commitment. That's part of what creates the stickiness and the stability in this asset class, is because each one of our tenants that are paying rent for the parking space that their home sits on, they're a homeowner. and they made a permanent housing solution when they purchased their home. So that's why it's important. Back to your question about underwriting, it's probably the most difficult thing to step into with no background or experience to get that right. There's market dynamics that are at play. Some markets, we have the best we've ever done is we sold 48 homes in one of our properties in a single year. But that same year, we only sold 15 homes at another property in a different state. So the market's there's factors at play that if you don't get it right, then you can wildly be off in your underwriting. But that's just one example. You asked about acquisitions of properties. It is getting more difficult to acquire mobile home parks, especially the type that we're seeking to acquire, because the pool of parks is shrinking. It's hard work, and I'll lean into the strategies that we use. But there's about 80,000 mobile home parks in the United States, roughly. 50,000 of those, in our view, are too small. For most people, you gain scale at about 50 units. So the economies of scale really are kind of working against you until you get up to about 50 units. We like to be above 100 units because it's just as much work to do a 100-unit property as it is to do a 50-unit property. But if you start to kind of really narrow down the percentage of these 80,000 properties that would be attractive to us, it's probably only 20% because of the size and location. Location is extremely critical to us, and then the size and quality is critical to us. Well, about half of those have already changed hands from the original owners or the families that built them to the institutional owners in this space or the large professional players in the space. So it's a pretty competitive space. They don't come available for sale very often. So our success has shown up in buying them when they're not for sale. This involves direct approach, both through brokers who do off-market stuff and through our own internal efforts to approach owners directly. So otherwise, there's just not enough volume available for sale. It's difficult. It requires consistent, everyday effort, reaching out both to owners and brokers that can help you.
But based on some of the numbers you were throwing around, you mentioned 15 grand just to turn a single trailer house around. I would imagine that you got to be prepared and have some reserves, whether it's a line of credit and a few other things in place just to make sure you can withstand what would be needed, especially if you're pulling in brand new trailer houses. I can't imagine that's cheap.
No, so all of that stuff gets modeled out. But I mean, the nice thing about brand new trailer homes is you purchase them, you set them up, and then you sell them. And upon the sale, you get reimbursed for the cost that you put into them. So yeah, you're still going to be, for a period of time, holding the cost of that on your own balance sheet. But as soon as it gets sold, it comes back to you. So typically there's kind of two ways that we'll approach infill. One is we'll raise the capital up front, sufficient to do those purchases. And the other way is we'll call it when we need it. So if there's a large project where there's 100 homes that need to be filled, it wouldn't make sense to raise the capital up front because now you're sitting on dormant capital that's not making any money. So, we'll typically purchase homes in tranches of about 10 at a time, $50,000 to $70,000 a piece, depending on the quality. If that's all you have is 10 vacant spaces, well, then we just raise that at the beginning of the project when we're closing. But if there's 100, we would do that in tranches. And we would still get the investor commitment up front for those dollars, but we wouldn't call it until we needed it. That's the two ways that we approach that.
Yeah, there's just a lot of aspects to the business of owning one of these. Before we jump into rapid fire and close out this episode, is there anything else we should have tried to hit on, Jack?
I think that the thing that is important to investors, and this is a discovery that we've made over time, particularly the smartest programmatic large check writers that follow us around and drip into every deal that we do, the most attractive thing about mobile home parks to them is the tax favor. For your audience, bonus depreciation is extremely powerful, particularly when you hold an asset for a long time. The recapture doesn't take place until you sell it. just to kind of share, like last year, for example, for every dollar that was invested in an asset that we purchased last year, investors received 85 cents on their K1 in passive losses. And that's where the power is. So they're harvesting passive losses that they can either use against this investment over time, or they can apply those to other qualified passive gains that they have in their life. So they can offset paying Uncle Sam more taxes. So there's an extremely powerful tax strategy with mobile home parks, particularly if you keep them as legacy assets and you don't sell them, or you keep them at least long enough for the real time-weighted value of money to surface. So that's probably the one thing that, I mean, there's still quality yields. So you should be able to get a mid-teen IRR. The monthly or quarterly cash flow distributions can range anywhere between 6 and 10% on the stabilized side. So they're still attractive. There's low volatility. You're not exposing yourself to loss of capital like you would be in some other real estate, but that tax advantage is just unbelievable.
Well, I really appreciate your time here, Jack. This has just been very interesting. 52ten.com, 52ten.com. It's going to be a clickable link in the show notes. But if you're ready, Jack, we'll jump into the rapid fire.
Let's do it. Let's do it.
What lie do real estate investors often tell themselves?
If I could look at the lies that I've told myself and reflect on those, I think this is a very scalable business if you approach it with that intent. And the lie is that nobody else can do it as good as I can, meaning there's no ability to scale. So I think just like any other business, this business is very scalable.
If you could go back in time and give your younger self a piece of advice, what would it be?
Ooh, the younger real estate investor, I would surround myself with people who had already done it.
Do you have a book recommendation?
Probably the best book that I've ever read about real estate is called The Secret Lives of Real Estate and Banking. It's written by Philip J. Anderson, and it essentially covers historic real estate cycles all the way back to, 200 years worth of data that cover the repetitive nature of real estate cycles. I learned more about real estate and the behavior over a macro window in that book than any other book I've ever read.
What single strategy or tool have you implemented that has had the biggest time-saving impact to you or your business?
The one that jumps out would be third-party fund administration. So in this business, you either do all the reporting and you do all the distributions and all the calculations and all the reconciliation yourself in-house, or now there's third-party vendors that specialize in that and they do it all for you. And it's twofold powerful. I don't have to build that in-house. And then they offer, since they're a neutral party, they offer transparency to our investors. So they know we're not cooking the books or going to pull a Bernie Madoff on them. That has saved us both time and money by quite a wide margin.
Well, this was fantastic. Again, it is 52ten.com, 5210. I really appreciate your time, Jack. This was great. It was great to meet you.
Well, it's always nice to spend some time with another guy named Jack.